China's domestic silver stockpile tightening through industrial absorption and policy-linked procurement channels, quietly shifting global price elasticity. Tracing how state-directed industrial demand gradually converts a commodity into a strategic buffer against external financial pressure. Unique angle. Silver is not being treated as a precious metal in China, but as an industrial choke point parallel to rare earth dominance. Mood applied, cold and methodical. Part 1. There's a strange thing happening in the global silver market, and it doesn't look dramatic at first glance. No panic headlines, no sudden price spike that screams manipulation. Just numbers that keep refusing to behave the way traditional supply and demand models expect. Silver is supposed to be one of the most liquid commodities in the world. It trades across London, New York, Shanghai. It moves through ETFs, futures, industrial contracts. And yet, beneath that surface liquidity, physical inventories have been tightening in ways that don't fully reconcile with visible demand curves. Now place China into that system, not as a passive buyer, but as a state that treats commodities differently when they sit inside strategic planning cycles longer than a decade. Officially, China doesn't talk about weaponizing silver. That would be the wrong framing. What it does instead is more procedural, almost bureaucratic. It folds silver into industrial policy the same way it did with rare earths in the early 2000s, quietly, incrementally, and with a preference for domestic absorption over external dependency. The key detail is this: China is the world's largest producer of silver, but it is also one of the fastest growing industrial consumers of it. Solar panels alone are a major sink. Photovoltaic cells require silver paste for conductivity, and China dominates global solar manufacturing capacity. Add electronics, EV components, 5G infrastructure hardware, and you start to see a pattern that isn't about jewelry demand or speculative holding. It's structural consumption. And here's where the mechanism becomes more interesting. Unlike oil or copper, silver has a dual identity that complicates pricing models. It is both a monetary asset in global finance and a critical industrial input. That duality creates friction when a large, coordinated industrial base begins to absorb supply faster than recycling channels can compensate. China's approach doesn't require it to corner the global market outright. It doesn't need a headline-grabbing monopoly. It only needs to reduce the marginal availability of freely floating physical silver while expanding locked-in domestic usage. That's a slower, less visible form of control. Think about what happened with rare earths in the 2010 seconds. The early perception was that China was restricting exports. The deeper reality was more layered. Consolidation of mining, environmental regulation that reshaped global supply chains, and internal prioritization of downstream industries. The export restriction was just the final visible layer of a much longer structural shift. Silver is not at that stage yet, but the architecture rhymes. The global market often assumes silver availability is elastic because above-ground stocks exist in vaults, ETFs, and industrial recycling loops. But those stocks are not uniformly accessible. A significant portion is already financialized, spoken for through paper claims rather than physical delivery. That distinction matters more when a large industrial economy is steadily increasing its physical drawdown, even modestly, year after year. And there's another layer that rarely gets discussed in mainstream commodity analysis. China's financial system does not treat commodities purely as hedges or speculative assets. It treats them as strategic inventory buffers against external currency volatility. That mindset changes procurement behavior. It prioritizes accumulation during periods of price stability rather than reacting to spikes. So instead of chasing silver in moments of scarcity, the system tends to absorb it quietly when global attention is elsewhere. Which raises a simple but uncomfortable question. If industrial demand continues to rise, and if a growing share of physical silver becomes internally locked within one of the world's largest manufacturing ecosystems, what happens to the price discovery mechanism that assumes global fungibility? There's no crisis in the data yet, no visible rupture, but the structure is beginning to tilt in a way that makes the next phase less about whether silver is important and more about who gets to define its availability. And that's where things start to shift from commodity analysis into something closer to industrial strategy. We'll need to look at how that strategy actually expresses itself through policy channels, recycling systems, and global trade flows before the picture becomes fully visible. If you want to understand why silver behaves differently from other industrial metals in China's system, you have to stop looking at it as a standalone commodity. It sits inside a broader machinery where energy policy, export manufacturing, and material security all feed into each other without needing a public narrative to connect them. Take solar manufacturing. China didn't just become the largest producer of photovoltaic panels by scaling assembly lines. It built a vertically integrated chain that stretches from polysilicon refinement down to silver paste application on individual cells. That last step sounds minor until you realize it turns silver into a recurring input, not a one-time extraction demand. Every gigawatt of solar capacity adds a slow, compounding pull on silver inventories, not explosive, just persistent. And persistence is often more destabilizing to supply chains than spikes. Now compare this to how Western commodity markets usually interpret demand. Analysts tend to model consumption as cyclical, tied to GDP growth, interest rates, or short-term industrial output. But China's industrial planning doesn't always behave cyclically. It behaves structurally. Once a sector is designated as strategic, solar, EVs, semiconductors, the input demand becomes semi-locked. This is where silver quietly stops behaving like a precious metal and starts behaving like a controlled industrial feedstock. There's a precedent here that's worth revisiting, even if it's often simplified in commentary. In the early 2010s, China's rare earth strategy wasn't just about export quotas. It was about building downstream processing capacity inside China while gradually reducing the strategic value of exporting raw or semi-processed material. The result was not immediate monopoly power, but long-term leverage over price formation and supply sensitivity. Silver doesn't have the same geological concentration advantage as rare earths. That matters. But it does have something equally important in modern economies: embedded usage inside technologies that are politically prioritized. Now consider recycling, which is often presented as a stabilizing force. Silver is heavily recycled from industrial scrap, especially electronics and solar panel waste. But recycling is not a frictionless loop. It depends on collection systems, purity recovery rates, and economic incentives that fluctuate with price. China's advantage here is not just industrial scale, it's integration. Scrap doesn't need to cross fragmented borders with different regulatory regimes. It moves inside a more unified industrial ecosystem, where recovery and reprocessing can be coordinated with manufacturing demand. That doesn't eliminate scarcity pressure, it just dampens volatility inside the system. Meanwhile, outside China, silver flows through a more fragmented architecture. Mining in Latin America, refining in a few specialized hubs, trading in London and New York, financial exposure layered through ETFs and derivatives. That structure assumes convertibility, that paper claims can always be reconciled with physical availability if price signals adjust enough. But price signals don't work cleanly when one major industrial actor is consistently absorbing supply at the margins without participating in the same speculative feedback loops. There's also a subtle geopolitical layer here that doesn't get stated directly. Silver is not classified as a critical mineral in the same way lithium or cobalt is under most Western policy frameworks. That means it operates in a kind of regulatory blind spot. It is too common to be strategically flagged, but too important to be irrelevant. China doesn't need to redesign global policy to exploit that gap. It just needs to operate inside it long enough for structural dependence to accumulate. And this is where the counter-argument usually comes in. Silver is abundant, and prices will simply adjust to incentivize more mining and recycling. In theory, that's correct. In practice, mining capacity expansion takes years, sometimes a decade, and it responds to price signals that are often lagging indicators rather than forward ones. So the system can drift for a long time before it corrects, which leads to a more uncomfortable observation. If China's industrial demand continues to grow at even a moderate pace, and if its internal recycling and allocation systems keep improving efficiency, then global markets may not experience a silver shortage in the dramatic sense. They may instead experience something quieter, a gradual tightening of free-floating supply, higher volatility in futures markets, more aggressive competition for physical delivery in stress periods, and a growing gap between paper liquidity and actual usable metal. At that point, the question stops being whether silver is scarce. It becomes whether scarcity is even visible in the same way anymore. There's a point in commodity systems where the debate stops being about demand and supply in the classical sense and starts becoming about access tiers. Who gets guaranteed physical delivery? Who gets financial exposure? And who is left relying on a market price that may no longer reflect friction in the real world? Silver is quietly moving closer to that threshold, not because of panic buying, but because of layering. Layering of industrial use, financial claims, and policy-backed domestic consumption that doesn't announce itself as coordination. Now, if you zoom in on global silver inventories, especially the ones tracked in visible Western reporting like COMEX warehouse stocks, you'll notice something important. The headline numbers don't collapse dramatically. Instead, they fluctuate within ranges that look stable on paper. But stability in inventory data can be misleading if the composition of ownership changes underneath it. More metal gets tied up in long-term industrial contracts. More is held in forms that are not immediately deliverable. And more gets absorbed into systems that don't recycle it back into global trade at the same velocity. This is where financial structure starts to matter as much as physical flow. Silver markets are heavily influenced by paper instruments, futures contracts, ETFs, unallocated accounts in London's OTC system. These instruments work efficiently when physical redemption is rare. They start to strain when redemption demand rises even slightly, especially in a tight supply environment. And here's the uncomfortable detail. Most participants in silver markets are not actually positioned for delivery. They are positioned for price exposure. That gap works fine until someone in the system is structurally more interested in physical accumulation than price speculation. China's role in this is often overstated in conspiratorial terms and understated in structural terms. It is not cornering silver in the classic sense. There is no single coordinated global squeeze. Instead, what exists is a persistent industrial absorber operating at scale inside one of the largest manufacturing ecosystems in history. That distinction matters because corners break. Structural absorption just compounds. There's another dimension worth adding here that is often ignored in Western analysis: time preference. Financial markets tend to operate on quarterly horizons. Even long-term investors still think in cycles of earnings, policy shifts, and macro indicators. China's industrial policy cycles operate on different timelines, 5, 10, sometimes 15 years, especially in energy transition sectors. That mismatch creates blind spots. Markets underestimate slow absorption because it doesn't register as urgency. Let's take solar again because it's the cleanest illustration. Global solar installations keep accelerating, but the silver intensity per unit doesn't disappear even as efficiency improves. It declines slowly, not abruptly. And even small per unit declines are offset by sheer volume growth. So total demand doesn't fall, it just grows more quietly. Now layer in EV production, grid infrastructure upgrades, and consumer electronics. None of these individually look like a silver shock. Together, they create a persistent industrial floor under demand that doesn't fully retreat. The key question is not whether silver is going to run out. It almost certainly won't in geological terms. The question is whether marginal supply becomes more expensive and more politically mediated over time. Because when that happens, pricing stops being a pure reflection of extraction costs and starts reflecting allocation priorities. There's a historical parallel here that's imperfect but useful. Oil in the 1,970 seconds didn't become scarce in absolute terms overnight. What changed was control over marginal supply and the political conditions under which that supply reached markets. That shift redefined pricing power globally. Silver is not oil, but the mechanism, control over marginal availability rather than total abundance, is structurally similar. And this is where the tension sits. If silver continues drifting into industrial lock-in while remaining financially treated as a highly liquid paper asset, then the system carries a quiet contradiction. It assumes infinite convertibility between paper and metal that may not always exist at the same friction level, which raises a question that doesn't have a clean answer yet. At what point does industrial consumption stop being just demand and start becoming a form of strategic storage disguised as production? Because once that line blurs, the market is no longer just pricing a commodity. It is pricing access to a system dot. At this stage, it's tempting to look for a dramatic endpoint, a shortage event, a price shock, something clean enough to summarize the story in a headline. But silver doesn't usually resolve like that. It drifts, it tightens, it reclassifies itself inside the system before anyone agrees on what changed. And that's really the point. If you strip away the noise, what's happening with silver is not a supply crisis. It's a governance shift over how a globally traded input gets allocated when one major industrial power builds deep, recurring demand into sectors that are politically non-negotiable: energy transition, electronics, and advanced manufacturing. China's position in this isn't about dominance in the simplistic sense. It's about structural insulation. When you produce most of the world's solar panels and a large share of its electronics supply chain, you don't need to buy silver aggressively in visible bursts. You just make sure your internal system never runs short. The external effect is secondary, and that's where Western market interpretation often misfires. It still treats commodities as if they exist in a single shared pool, where price is the universal allocator. But in reality, large industrial systems can carve out semi-contained submarkets inside global supply chains, not by breaking trade, but by steadily internalizing flows. This is where the rare earth comparison keeps coming back, but even that analogy is incomplete. Rare earths required processing concentration to create leverage. Silver doesn't need that. Its leverage comes from dispersion, because it's everywhere in modern electronics, small enough to be ignored individually, large enough to matter collectively. So what would actually change the trajectory here? Not a collapse in supply, that's unlikely. The more realistic pressure point is liquidity fragmentation, a widening gap between available on paper and available for delivery without disruption. That gap doesn't announce itself clearly. It shows up as slightly more aggressive futures pricing during stress periods, longer settlement chains, higher premiums in physical markets when industrial demand spikes unexpectedly. And markets tend to normalize those signals right up until they can't. Now, I'm not fully convinced this becomes a crisis in the traditional sense. There's a strong counter-argument. Recycling efficiency will improve, substitution will slowly reduce silver intensity in certain technologies, and price increases will naturally suppress marginal demand in less critical uses like jewelry and small-scale electronics. That argument is technically correct, but it misses timing. Adjustments like substitution and recycling don't happen at the same speed as policy-driven industrial expansion. One is adaptive and slow. The other is directional and coordinated. So the imbalance isn't permanent, but it can persist long enough to matter strategically. Here's the part I keep coming back to. Silver sits in an unusual category where it is too industrial to be purely financial and too financial to be purely industrial. That dual identity creates blind spots in both policy and markets. Each side assumes the other will absorb shocks that neither fully controls. And China's system, intentionally or not, is better positioned for that ambiguity. Not because it dominates silver outright, but because it integrates it into long-term industrial planning rather than short-term price exposure. If that continues, the outcome won't look like scarcity in the textbook sense. It will look like stratification, different tiers of access depending on who is using silver, for what purpose, and inside which system. That's a harder condition to model, and even harder to react to in real time. I'm not entirely certain how far this goes. The data supports the direction, not the conclusion. But if you extend the current trajectory forward a decade, the more interesting shift isn't price, it's definition. Who gets to treat silver as a freely traded global input, and who increasingly experiences it as a locally managed industrial resource? And once that split becomes visible, it doesn't reverse quickly. If this connected the dots in a way that felt useful, subscribe. And more importantly, watch how industrial metals get discussed over the next few years. The language will start to change before the prices do.